Hello, team. Welcome to my class. This is Dr. Haris Tahir. Uh, each week, I will post a video which would analyze your work in that week. These videos would come after you have created the knowledge in the form of assignments and discussions. And I would analyze your responses and add my 2 cents to it. This way, we would be able to create more knowledge. It's exciting to be leading this learning effort, and I am really amazed by the responses that you have posted in the first week. So, let me talk a little bit about some basic concepts of finance. In every video, I will talk about these concepts in the beginning, and then I will get to that week's assignments and questions. First of all, let's talk about a basic concept of raising money or raising liquidity. Money is the lifeblood of any organization. If an organization needs to survive or needs to grow, it needs money. Especially the young organizations that are in the beginnings stage of their growth cycle, they need a lot of money to grow. Imagine Starbucks many decades ago. It was one coffee shop that was selling coffee by the pound until Howard Schultz realized that he went to Italy and he saw the cafes and he says that the coffee should be an experience. And then from one Starbucks in Seattle to a few dozens and then a few hundreds, and now more than 20,000 Starbucks. That's immense growth. You need money for this type of growth. So there are 4 sources of money. Number 1 is the free cash flow. This week we talked about free cash flow. I really loved your responses on free cash flow. Free cash flow is a way to have your growth activities. That's one. The second is sale of assets. This can be a small asset like an R&D facility or a spin-off, which is a big company may own many smaller companies, and you just take one company and then spin it off and make it an independent IPO, initial public offering in the stock market, and take that money and bring it into your main company. For example, Philip Morris, which we know for its cigarette business, had a diversified business called Kraft Cheese, and they spun it off and then brought that money back into the bigger company, the mother company. So sale of assets, free cash flow. The third, you're all familiar with it, is the issue of equity, providing an equity stake. It's done in 2 ways. One, you can do the initial public offering. You're a private company, you go public, and then the company is valued at a certain valuation, and then a market cap is decided, which is market cap equals the share price times the number of shares outstanding. SEC approval, Securities and Exchange Commission is brought in, and there's the whole IPO process. Probably we would go over it in one of these weeks in one of the chapters in the text. So sale of equity brings a huge, big cash injection into the company, and that enables the company to develop more R&D, to innovate, to bring in new products, open new stores, all of this growth activities. For example, when Facebook went public, it was valued at a whopping $100 billion. That is a huge valuation. Sometimes you get crazy valuation for the company, and it's just basically, as the beauty is in the eye of the beholder, the market cap is in the eyes of an investor. Another example, King King Digital, I believe, the name of the mother company that has a one-hit wonder, which is Candy Crush. When they came out public, they were valued at $7 billion. So the sale of equity brings in a lot of cash. So what if you already did an IPO and you need more cash? Well, you can have additional offering. So you get SEC approval to offer additional shares, and then that additional offering brings additional money. What's the drawback? The drawback is it dilutes the EPS, because now more shares are divided by the same earnings. So the EPS goes down and the PE goes up, which both bad short term, but long term, if the growth materializes and the EPS goes up as a result, then the PE goes down, and all is a happy conclusion. So we talked about free cash flow to raise money, sale of assets, that includes a spin-off, and issue of equity or additional equity. The fourth and final way to bring money into an organization is issue of debt, corporate bonds. So you can issue corporate bonds. Each bond has a rating. If your rating is very good, like AAA, even the US government doesn't have a AAA, now it was reduced to a AA. You bring in capital at a very low cost. So from AAA to BBB, you are considered investment grade, and investors are willing to give you money for less interest. But then below that, you're a junk grade, and the cost of borrowing goes very, very high. So perhaps we would have a chapter on debt later on in the class. So 4 ways to raise money: free cash flow, sale of assets, issue of equity and additional equity, and issue of debt and additional debt. The 3 of these 4 is done by investment bankers. Investment bankers are responsible for raising money through issuing new debt, new equity, and things of those nature. So that was the topic that I wanted to talk about today, is how to raise money. Now let's get to our weekly questions. The question 1, I really enjoyed the academic discussion that we had amongst the 21 members of the class, and I'm the 22nd leading this learning effort. And you really got the point that yes, short term, it's going to affect the EPS and the PE. The EPS is going to go down, the PE is going to go up, and that might be a turnoff for the investors, and stock price may go down. Most of you said the stock price may go down short term. Some of you said that the stock price may go up. So there are a few considerations here. First of all, if this company in question, in discussion forum 1 of week 1, is a growth company, then most of the growth companies, young growth companies, either don't pay dividends, or their dividend payout ratio is such that they are keeping 90% of the earnings as retained earnings and only paying 10% of the dividends. So if it's a growth companies, the investors, the target market of investors already understand that this is a growth company, and they're not going to pay much attention to the short-term fluctuations in the PE and the EPS. They're going to look at the larger term picture. Let me give you some examples. Tesla. If you look at the Tesla stock, by the way, if you wanted to do the stock analysis, a best place to go is Yahoo Finance. So you type in www.yahoo.finance.com, and then either type in the company name or the ticker symbol. TSLA is the ticker symbol. It's going to bring in the graph, but the most important area to look at is key statistics under Yahoo Finance. If you click on key statistics, it's going to give you some really vital statistics. It's going to give you market cap, how big the company is. So, for example, the biggest company on the face of the earth is Apple Computers at more than $700 billion of market cap. It will tell you what is their top line, which is revenue or sales. What is their bottom line? What is the top line growth? What is the bottom line growth? So these are some additional considerations that you have to bring into the discussion. While bottom line is suffering clearly short term because the expense has gone up in technology and R&D, the top line probably would stay the same or even increase. So that's one consideration, that the growth investors may not always look at the bottom line, the net profits. So we would refer to profits as bottom line and revenues as top line, as practitioners do. So top line clearly would not suffer. The bottom line would fluctuate short term. But the growth investors understand that these companies, their bottom line is something not to look at. There are other variables that they need to look at, and not just the bottom line. Blue chip investors, on the other hand, the dividend-paying companies, the mature companies like IBM, like Pico, which is another name in the stock market, like GE, they are dividend-generating companies, utility companies especially. They pay very high dividends. So if they do something like this, their dividend is going to get affected, and investors are going to start walking away from the company. But growth companies either don't give dividends or they give very little dividends. Like their dividend payout ratio would be 10%, 90% keeping in retained earning. So out of the total earnings, you have retained earnings and you have dividend. And the dividend payout ratio is what percentage of the earnings you're paying out as dividends. So this type of company is going to be a growth company, which is not going to be affected by the fluctuations in PE and EPS. Investors would understand. Their target market investors would understand. So therefore, you see investors flocking into Tesla, even though their PE is very high, their EPS is very low, if positive. Most of the time it's negative. Same story with Apple. Apple now started to have dividends, but very, very small dividend. The payout ratio is minimal. You can go on Yahoo Finance and pull it up, and you would see the payout ratio under key statistics. Very good place to go. Finance.yahoo.com, put in a ticker symbol, and then put in click on the key statistics, and then you would see the market cap, the revenue growth, the bottom line growth, what percentage owned by the institutions, what is the dividend payout ratio. All of those statistics are all in one page, very beautifully put, about any company that you're researching. So we do need to look at the target market of investors. So I think that they would not have much of an effect if they are a young growth company making a huge technology investment. On the other hand, the young growth companies, if they stop innovating, they're considered clinically dead. So they have to make a lot of investments into their R&D and into their growth activities. So once they become blue chip or very mature companies, then they start paying more dividends, and then it's a totally different type of investors that is attracted to those companies. So these are the few considerations. All of you did a very good job with assignment 1 in week 1. I like how you organize your responses. I really loved reading through those. So I will see you again at the end of week 2 with another video talking about your work in week 2. And then also I will explain the class project to you. So all the upcoming assignments are going to be project related. So we're going to break that big project into small logical pieces, and then one piece is going to be due at each week. And so this is sort of like a big, huge case study. So again, I welcome you all to my class, and welcome aboard. And we are going to create a huge mountain of learning together. And it's exciting for me to be leading this learning effort. I'll see you after week 2.